In the first quarter of 2025, Warren Buffett did something he has only done 3 times in his entire 74-year investing career. He ran. Not walked, not rebalanced. He ran for the exits, selling $180 billion in stock over 18 months. He slashed his Apple position by 67%. He dumped Bank of America shares for 12 straight weeks. He liquidated positions he swore he would hold forever. And when the dust settled, Berkshire Hathaway was sitting on $334 billion in cash, the largest cash hoard in corporate history, larger than the GDP of Ireland, larger than the entire market cap of Netflix, Starbucks, and McDonald's combined. This isn't normal portfolio management. This is the Oracle of Omaha screaming a warning that most investors refuse to hear. A warning he issued before the dot-com crash, before the 2008 financial crisis, and before every major market collapse of the last quarter century. And I'm going to show you exactly why this time could be the biggest warning yet. Let me be clear about something from the start. Warren Buffett doesn't panic. He doesn't react emotionally. This is a man who sat through 27 bear markets and 14 recessions without flinching. He's famous for saying his favorite holding period is forever. So when this man sells $180 billion in stocks and builds the largest cash position of his life, you should pay very close attention. Because Buffett has a pattern, a predictable, historically verified pattern that has repeated before every major crash in modern market history. And that pattern is flashing bright red right now. Here's what the financial media won't tell you. Buffett's cash-to-assets ratio just hit 28%, the highest level in 40 years. His net stock sales over the last 9 quarters represent the longest sustained selling streak in Berkshire's 60-year history. And his public statements have shifted from cautiously optimistic to eerily silent. The last time all 3 of these signals aligned was late 2007. You know what happened 6 months later? Let me show you what Buffett is looking at. The Shiller P/E ratio, which measures stock valuations, currently stands at 37.4. For perspective, it was 27 before the 1929 crash. We are in the 99th percentile of all historical valuations. The Buffett indicator, which compares stock market value to GDP, is at 195%. The historical average is 85%. This is not opinion. This is math. But it gets worse. Interest payments on the national debt just exceeded $1.1 trillion per year, more than the entire defense budget. Commercial real estate has $2.2 trillion in loans maturing before 2028, while property values have fallen 40%. Banks are sitting on $700 billion in unrealized losses. Consumer credit card debt hit a record $1.14 trillion, with delinquencies rising at the fastest rate since 2008. Warren Buffett has access to data most of us will never see. And his response to what he's seeing is to sell everything and hold cash. That should tell you everything you need to know. Thanks for watching. Let me show you a pattern. The exact sequence Warren Buffett has followed before every major market crash. I call it the Buffett exit pattern, a 4-stage sequence that has predicted every market collapse with terrifying accuracy. Stage 1. Silent accumulation. During market crashes, when fear is at its peak and prices are at rock bottom, Buffett deploys cash aggressively. He buys when there's blood in the streets, accumulating assets at generational discounts. This is how he builds his wealth. Stage 2. Patient holding. As the markets recover, Buffett holds his positions. He lets compound interest do the heavy lifting. He might seem inactive, even boring, but he's watching, studying, and constantly analyzing valuations. Stage 3. Quiet trimming. When valuations start to look stretched beyond reasonable levels, Buffett begins to sell, very quietly. He starts with smaller positions, taking profits without drawing much attention. The financial media barely even notices. Stage 4. Emergency liquidation. This is the critical stage. When Buffett sees systemic risks that the market is ignoring, he shifts from just trimming to dumping assets. His sales accelerate dramatically, and his cash levels spike. The selling becomes impossible to ignore. Right now, we are deep into Stage 4. This isn't the beginning of Stage 4. We are in the most aggressive stage 4 selling in Berkshire Hathaway's entire history. And if this pattern holds true, what comes next is the crash that justifies all this selling. Let me prove it with 2 historical examples that will send a chill down your spine. First, the dot-com crash of 2000. In the late 90s, the stock market was in a frenzy. Internet companies with no earnings or revenue were valued in the billions. The Nasdaq soared 400% in 5 years. Wall Street declared a new paradigm. But Warren Buffett refused to join the party. His cash position swelled to a record $36 billion by 1999. He was mocked, called a dinosaur. His response? He kept building cash. Then, the Nasdaq crashed by 78%. $7 trillion in market value vanished. But Buffett was sitting on cash, ready to deploy. Stage 4 behavior, followed by Stage 1 deployment. The pattern worked perfectly. Next, the 2008 financial crisis. By 2006, the housing market was a massive bubble. Buffett saw the danger. He called derivatives financial weapons of mass destruction and started building cash. By mid-2008, Berkshire's cash pile hit $44 billion. His selling of financial stocks accelerated. Classic Stage 4 behavior. Then, Lehman Brothers collapsed, and the market crashed 54%. But Buffett was ready. He made legendary deals with Goldman Sachs and General Electric, securing incredible profits. Again, Stage 4 selling, market crash, Stage 1 deployment. The pattern repeated perfectly. Today, the signs are all there. The pattern is repeating. If you want to understand what this means for your money, make sure you follow for more updates. Thanks for watching. Let's look at the COVID crash. This one is critical because it explains why Buffett's current selling is so aggressive. By late 2019, before anyone had even heard of COVID, Buffett's cash pile had already hit $128 billion. The market was at all-time highs, but he was building cash anyway. Then, March 2020. COVID crashed the market 34% in just 23 days, the fastest bear market in history. But then, something unprecedented happened. The Federal Reserve stepped in with, essentially, unlimited money printing. Trillions in stimulus flooded the system, and interest rates were slashed to zero. The government even started propping up corporate bond markets. The result? Markets recovered in just 5 months. The crash was over before it really began. But Buffett didn't buy aggressively. In fact, he sold his airline stocks at a loss and got criticized again for losing his touch. But here's what everyone missed. Buffett saw that a natural market correction had been artificially stopped. Valuations didn't reset. They just reinflated. Zombie companies that should have gone under were kept alive on life support. The bubble didn't pop. It was just pumped up to an even more dangerous size. So, what did he do? He built even more cash. From 2020 to now, his cash has exploded from $128 billion to a staggering $334 billion. While everyone else was caught up in the buying frenzy, he was quietly selling. He's not preparing for a normal recession. He's preparing for the crash that COVID only delayed. Now let me show you what this looks like in real time. In 2024 alone, Buffett sold $75 billion worth of Apple stock, cutting his stake by 67%. This was his biggest holding, his forever stock, gone. He sold Bank of America shares for 12 straight weeks, a $10 billion position he spent years building, dumped in a matter of months. He completely exited his position in Paramount Global, taking a $1.5 billion loss. Think about that. Warren Buffett almost never sells at a loss. He's held stocks through 50% drops without flinching. Taking this loss tells you he sees something much, much worse on the horizon. He even stopped buying back his own company's stock, which he used to call simple mathematics. Now he's hoarding every single dollar. And here's the detail that should really get your attention. In his annual letter, Buffett always praises the American economy. It's his brand. This year, he warned about fiscal deficits and questioned government spending. He's voicing concerns he has never expressed publicly before. Warren Buffett is telling you, in every way he can, that trouble is coming. The only question is, are you listening? Now I know what you're thinking. Buffett is 94 years old. he's just being conservative. But in 2022, at 92, he made his largest acquisition in a decade. He's not slowing down, he's just being incredibly selective. And right now, he's selecting cash. But AI will justify these valuations. That's exactly what people said about the internet in 1999. We all know how that ended. Technology doesn't prevent bubbles from popping. The Fed will just save us again. In 2020, they had room to cut interest rates. Today, inflation is sticky and government debt is through the roof. The ammunition they used last time is gone. This time isn't different. The pattern is clear, and it's unfolding right now. Thanks for watching. So, what do you actually do with this information? Let me tell you what Buffett's actions are teaching us. First, cash is not a waste during bubbles. Wall Street constantly tells you to stay fully invested, that cash is a drag on returns, that you're missing out. But the greatest investor in history is holding 28% of his assets in cash. During bubble periods, liquidity isn't weakness. It's ammunition for what comes next. Second, quality survives crashes. Look at what Buffett is not selling. Coca-Cola, American Express, Occidental Petroleum. These are businesses with real cash flows, real competitive advantages, and real pricing power. They can survive anything. He's selling high multiple tech and leveraged financial companies. The message is crystal clear. Third, optionality is everything. When markets crash, prices hit levels that seemed impossible just months before. Those with cash can buy at those levels. Those who are fully invested have no options. They either sell at the bottom or ride out devastating losses. Having dry powder when others don't is the ultimate advantage. And fourth, be willing to look wrong. Buffett was mocked in 1999. He was criticized in 2007. He was questioned in 2020. He didn't care. He followed his process and trusted his analysis. The people who mocked him are now studying him. Being early is not the same as being wrong. Here's the biggest mistake people make when they hear this. They do nothing. They see the data, they recognize the warning signs, and then they continue as if nothing has changed. This is normalcy bias, the belief that things will just keep going as they always have, even when evidence screams otherwise. The market always recovers. The government won't let it get too bad. The investors who lost 78% in the dot-com crash had evidence. They ignored it. The investors who lost their homes in 2008 had evidence. They rationalized it. Warren Buffett is showing you, with $180 billion worth of actions, exactly what he believes is coming. You can ignore it, or you can recognize that the most successful investor in modern history is sending a signal. The same signal he sent before every major crash. Based on this pattern, here's what to expect. In the next 6 to 18 months, volatility will increase dramatically. The complacency we've seen will crack. In the next 1 to 3 years, expect a significant correction, a repricing of 30% to 50%. And when that happens, Buffett will deploy his massive war chest, buying assets at generational discounts, while others are panic selling. The question is, which side of that wealth transfer will you be on? If this analysis showed you something new, subscribe now and hit the notification bell, because this story is just beginning. In my next video, I'll reveal the 5 specific stocks Buffett refuses to sell at any price, and exactly why they are positioned to survive what's coming. This is information you can't afford to miss. The pattern is clear. The warning has been given, and the clock is ticking.